FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You're listening to the Financial Survival Network. It's Kerry Lutz. With us, Dave Kranzler of investmentresearchdynamics.com. And something's going on in Wall Street. Oftentimes, you know that you don't find out about it till many months later, just like the whale that almost sank JP Morgan. But that doesn't stop us from speculating about it. Dave, welcome back.
Thanks for having me, Kerry. It's great to be back.
Always a pleasure, you know that. So, hey, first, we talked a while ago about the housing stocks, how they had all pretty much put in a top. I guess it was last February. Then we had this guy from Hovnanian saying that, yeah, we were a little bit too optimistic. And we both know that the housing market has never come close to the levels that it hit in 05 and 06, probably not going to for decades, probably not in our lifetimes, is it?
I don't see how it can without any kind of meaningful economic recovery and any kind of meaningful income and wealth creation for the middle class. I mean, by all statistics, even the government's own statistics, the real median monthly average household income has been declining since 2007.
Right. And there's nothing that's going to make that go. I mean, certain states doing better than others, certain cities, metropolitan areas like New York, Boston, San Francisco, LA, your area in Denver, I guess Chicago, Nashville, Miami, metropolitan areas as a whole doing better, but how much longer they can go on holding up the national economy when you have the energy market in free fall, that's really what it comes down to.
Yeah, and actually, Kerry, I mean, some of the cities that you mentioned, like San Francisco and New York, it's been a lot of what you call doing well has just been a function of prices, especially at the upper end, going parabolic. And I think that game is over now. I know from friends of mine who live in New York, they've told me that the super high-end apartments that had crazy listing prices aren't moving, and you're starting to see a glut of new apartment buildings, that cater to the mid-range. And so I think we've peaked in the housing market. I was probably a little bit early in calling the top, but I think what we've seen for the last 6 months has been kind of the proverbial blow-off top, and most of the hype has been driven by crazy price increases. And you just can't have a supportable, sustainable housing market when you've got prices going up like this at the mid-range and the upper range, and yet the bread and butter of the housing market, the first-time buyer and the move-up buyer, their income levels are stagnating to declining.
Yeah, and so of course, these housing stocks, and yeah, you just look at the Hovnanian stock chart, and they all mirror one another. It's got to be that way. And like you said, the high end, it's a very small portion of the overall market, only going to carry you so far. And yeah, so getting back to this derivatives issue. So your article, derivatives bomb exploded within the last 2 weeks. Just explain your thesis here, what you think happened and why you think it happened.
Sure. Just real quickly, just to circle back to the housing stock issue, because I think this is very relevant. If you, by any kind of financial measurement, the home builder stocks are significantly more overvalued now, especially in relationship to their underlying fundamentals being their unit sales run rate, the amount of inventory they're carrying, and the amount of debt on their balance sheet. Every single home builder stock I look at is significantly more overvalued now than it was at the peak of the housing bubble. And I think this sector is going to be one of the most dangerous ones to be long in, and I think you can make a lot of money on the short side when the stock market finally craps out, which we know is coming.
Mm-hmm. Yeah, well, it's certain inevitability to it, just a question of when, but every stock market bubble ends in a bust, and this one will no doubt end the same way. So circling back.
In terms of in terms of your second question, about my feeling or my instinct that something's happened behind the scenes in the financial system just in the last 2 or 3 weeks. This feeling kind of goes back to mid-December, and coincidentally, both John Embry and I kind of came to the same conclusion when we were looking at the manipulation and price suppression of the precious metals really intensified in mid-December. And we both independently said something must be going on behind the scenes that's really bad for them to intensify their manipulation of the precious metals. And it also seemed like they were intensifying their propping of the stock market.
Mm-hmm.
I mean, it was every time the stock market started to sell off in the morning, by the end of the day, we were either within a chip shot or at a new all-time high for several weeks in a row. And that was in the face of declining economic reports. And as everyone knows now, even by the government's trumped-up measurements, the GDP declined in the first quarter.
Yeah, absolutely.
So what kind of got my attention on my feeling that something happened in the last few weeks was the news report that came out over the weekend that the two co-CEOs of Deutsche Bank were fired. Obviously, the headline said they decided to resign, but clearly they were quote unquote shot in the head. And what made it even more interesting, one of the co-CEOs was really kind of the primary guy, was Anshu Jain. And literally within 3 weeks ago, I think it was on May 21st, Deutsche Bank had announced that there was a management restructuring and the board had given Jain even more power and more control over the bank. And then 2 weeks later, they shoot him in the head. So, what happened in that 2-week period that all of a sudden Deutsche Bank's board of directors and shareholders had this change of heart? And
question.
It's to me, it's connected to the fact that Deutsche Bank is the largest derivatives holder in the world. They have a bigger derivatives holding than JP Morgan does. And James' sole charge in life was when Deutsche Bank acquired Bankers Trust back in 1999, early 2000. James was sort of put in charge of building up their derivatives book and turning Deutsche Bank into the largest derivatives dealer in the world. And the only thing that I can think of is that there was some sort of derivatives accident on Deutsche Bank's balance sheet, and they had to get rid of them and bring in new guys to clean it up. So, and sort of the signals that I was looking at, because when I saw the Deutsche Bank story, this weekend I started looking at some market behaviors that I had been observing and thought were kind of unusual. And so, for instance, the Dow Jones transports have been underperforming the S&P. They've diverged negatively from the S&P 500 really since the beginning of May. But in mid-May, all of a sudden, the transports plunged, and the divergence between the transports and the S&P 500 widened. And even more interesting is, everyone knows about the well-publicized gap up in interest rates we've had, especially from the 10 to 30-year part of the Treasury curve. Well, there was a sudden gap up in the 10-year yield right on June 1st. And so I ran the correlation between the 10-year yield and the Dow Jones transports. And the Dow Jones transports have been in a downtrend really since the beginning of the year. And the 10-year yield has been in an uptrend since pretty much over the same time period, including this mysterious gap up on June 1st. Now, that's the exact opposite of what you would think would happen, because when the Dow Jones transports decline, that's an indication that the economy is weakening, right?
Sure, of course. I mean,
right. And so historically, in a clean market, when the economy gets weak, interest rates are supposed to go down, not rise.
Yeah.
So what is it about the fact that interest rates are gapping higher in the face of a weakening economy? And in my opinion, what that indicates is that the Fed is losing some control over its ability to keep rates suppressed at the long end. I mean, they can always pin short-term rates to zero by managing the Fed funds rate. All they got to do is flood the system with overnight liquidity, and it drives the short-term Fed funds rate to zero or even negative. But they have a harder time controlling the longer end of the bond market. And to me, it's kind of spooky, the fact that you've got the Dow Jones Transport telling us the economy's getting weaker. Obviously, the GDP contracted in Q1. It looks like by all private economic reports that have been released over the last couple of months that contraction from Q1 continued into Q2, and yet interest rates are going higher. And that's kind of as Greenspan would say, a conundrum.
Yeah, it's a conundrum that I'm glad I'm not responsible for.
Right, exactly. And so, in my opinion, especially with regard to the bond market, it reflects the Fed's inability or somewhat loss of control over the bond market. And I think that reflects that there was something that happened behind the scenes that's hidden from our sight in the derivatives world that has caused the Fed to lose some control over the markets. And, you basically the same thing with the S&P 500. I mean, if you look at a daily chart of the S&P 500, it looks like it's rolling over.
Mm-hmm.
And for the last 5 years, the Fed has been targeting the S&P, trying to drive it higher to, quote unquote, create wealth. So the Fed clearly doesn't want a lower stock market, and they don't want higher interest rates, and yet we're starting to get both. So to me, it just, especially in connection with whatever happened at Deutsche Bank, I think some sort of derivatives bomb went off behind the scenes, and we're seeing the effects of it in what I think is the Fed's decreased ability to control the markets.
Yeah, well, their net exposure is supposed to be zero, right? How can they lose money? It's all supposed to be netted out.
As long as no counterparties default, we're perfectly hedged.
Exactly, right? What could go wrong here? Nothing can go wrong, right?
Exactly. And, and again, it kind of relates to this sudden spike up in interest rate that's occurred in the last couple of weeks. And it's not just the U.S. Treasury market. I mean, it's been well publicized that the German Bund market has been spiking up in yield as well.
Right. That would really point to Deutsche Bank too, wouldn't it?
Right. Well, and the thing of it is, the financial media reports higher interest rates, but they don't connect it to the fact that there's 3 times as many face value interest rate swaps and bond market connected to the derivatives as are actual German bonds and U.S. Treasury bonds outstanding. So when you get high volatility in the bond market, it's going to reverberate into the derivatives market and cause problems.
Hey, and don't forget that their equity, their levels of equity are so narrow here, right? That the least little blip in rates can wipe out the equity of large banks, because
that's exactly right.
The little bit of gyration there, what's their equity? 150 billion or something like that, right?
That's right.
It's nothing, because 150 billion on some massive $1 trillion number is just a few basis points, basically. Isn't it?
That's right.
Yeah, so
that's exactly right. And really, where the immediate problem comes from is if you've put on a big bet that interest rates are going to stay low, or you put on if you've sold volatility via a derivatives, an OTC derivatives structure, and all of a sudden the volatility in the bond market spikes up, interest rates go higher, you're going to get collateral calls. You're going to have to post collateral margin against the decreased value of your derivatives holding.
Yeah.
And if you don't have the ability to post collateral to meet a margin requirement, that's when the whole daisy chain of derivatives explosions start.
Yep. Houston, we have a problem, right?
Right, exactly.
Mm-hmm. Yeah, it doesn't sound good. Does not sound good at all. And then there's other evidence there. Has there been any meetings at the White House or at the Fed or Treasury that we know of that have taken place in the past month or so? Emergency meetings or...
Not that I'm aware of, and I'm sure if we're having conversations about it, it wouldn't be reported. They keep it from the press.
Yeah, true.
Because news of those meetings would spread through the blogosphere, and that's their worst nightmare.
Yeah. Well, all they need, and that could just set off a chain reaction too.
Right, exactly.
Yeah, it's all they need. Just all.
The other interesting thing, and I talk about it in my blog post, is Paul Singer, who founded and runs Elliott Management. He came out about 2 weeks ago. It was actually at the end of May, and basically made a call to short anything with a paper currency claim on it. And he was largely referencing sovereign debt and treasury debt. But I'm sure he was also referencing mortgage debt and things like that. And a guy like that isn't going to come out and make a public call like that unless, one, he's already set up his funds in a way that he's basically shorted fiat currencies.
Yeah.
Number two, that he has some sort of insight about what's happening behind the scenes, probably even firsthand from insiders who were in a position to give him information. And number three, he wouldn't come out and make that statement unless he was 99% sure that he was right about it.
Oh, yes.
Because the last thing these big egomaniac hedge fund guys want is to make a call like that and then get egg on their face.
Nope, not a good thing. So
again, that kind of ties into why I think something happened in the last couple of weeks.
I think you're right.
That would elicit a guy like Paul Singer to come out and make that statement.
Yeah, I think you're right. And probably something going on there in China as well, because a bunch of defaults happened in China, some we don't even know about, and they've stopped bailing those companies out. Could be problematical. Anyway, Dave, tell us again where we find you, how we connect with you.
My blog is investmentresearchdynamics.com, and I try to post 2 or 3 what I hope are insightful articles a day. And I also have some proprietary research reports that I right now I focus on junior mining stocks and home builders. At some point I'm going to branch out as I get more comfortable with my view that the stock market's going to tank. I'll start coming up with some other good short sell ideas.
Well, any day now, that's for sure. And hey, you'll find the link to Dave's site in the show notes to this interview, as always, on financialsurvivalnetwork.com. Make sure you sign up for our free newsletter, our webinars. Just had a couple of great ones with John Embry and Rick Rule of the Sprott organization, and we've got more coming up. Dave, it's always a pleasure, and we're going to be watching this story because I know it's got to come out. It's too big not to. You're talking tens of billions, maybe hundreds of billions of dollars, and it's probably got something to do with Greece as well, and it's just too big a story to just keep under their hats indefinitely. Somebody's going to let it slip, and hopefully when it does, it'll really make a big impression, because the system's just too corrupt to keep going on like this. It's got to end, hopefully sooner rather than later. Dave, again, thanks. We'll talk to you soon.
Thanks for having me.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.